Most people know that you can make money in the stock market when a stock goes up or when a stock goes down. But there's actually a option strategy known as the Iron Condor where you can make money when a stock goes sideways, or even when something like the implied volatility of that stock goes down. In this video, we're going to talk about what an Iron Condor is, show an example of what an Iron Condor is, and then talk about a real life example or a trade that I put on recently that showcases everything to do with Iron Condors. If you're talking textbook definition for an Iron Condor, right from Investopedia, it's a strategy that consists of 2 puts and 2 calls. Each of those you're selling one, and at the same time you're buying one. All of those options that you're playing around with have the same expiration. That's a lot of mumbo jumbo that you probably wouldn't understand if you're a beginner. So let's break that down to just understand the purpose of an Iron Condor. The purpose of an Iron Condor is to make money from a stock trading sideways or implied volatility contracting. But for simplicity's sake, let's talk about just trading sideways for now. The past month, the NASDAQ QQQ, an index ETF, has traded between around 340 and 317. You can put on this strategy to say a month from now, you think the NASDAQ will still be between 317 and 340. And the Iron Condor strategy allows you to do that. And you make money if the NASDAQ stays within that range. Another way to think of the position is selling a bearish call spread and a bullish put spread at the same time. So that breaks it down into 2 simpler trades. And once you combine those trades, you're getting an Iron Condor. So let's go ahead and put on a bearish call spread and a bullish put spread at the same time to show you what an Iron Condor would essentially look like. So the expiration that we talked about was a month out, so 31 days from now. And then you're selling the 340 call and buying the 343 call at the same time. This is the bearish call spread of the trade. When you put this trade on, your max loss would be $193 and your max gain would be $107. So when you sell this spread, you're collecting $107, and the max you can lose is the width of the strike prices that you're kind of dealing with, and then you subtract out how much you're collecting up front. And this positive theta number means that every day that's passing, you're essentially making money for every day that goes by. Now, we just talked about the bearish call spread. What you have to put on now is also a bullish put spread, which is selling a higher striked put and buying a lower strike put. So in this case, we're selling the 317 and buying the 314. Once again, the width of the strikes is $3 wide. And in this case, you're collecting 46 cents or $46 as a credit. So on the bullish put spread, the theta is still positive, but it's less than the call spread because it's further away from where the NASDAQ is trading, which is 333. And so on this spread, you're collecting $46 and your max loss is $254. So what happens when you combine this bullish put spread and this bearish call spread? You got it. It's an Iron Condor. So if you put in all these option trades at once with the same expiration, your net credit would be 153, and then your max loss would still be 147. So it's the width of the strikes minus the total collection of credits. Your max P&L would be $153 and your max loss would be 147. Let's talk about the max loss side for a little bit because you're gonna have losing trades. You can't have every single trade be a winner. Otherwise, you'd be the greatest of all time. Here's the situation. If the stock decides to explode to the upside or just absolutely continues to crash, you're probably going to lose on the Iron Condor because it goes outside of that range. You have some wiggle room past the short strikes. It's the short strike minus the amount that you collected. So 340 to break even would be 340 plus $153. A break even of 341.53. And then on the short side, it's 317 minus 153. Pretty much have that break even, and then past that point on either direction, you start to lose money up to the point where if it passes the long strike on either side, it's going to be the max loss. Quick recap. We essentially are selling a bullish put spread and a bearish call spread at the same time. You're collecting a credit up front, and then you're making money as time goes by through theta decay. So every single day you could be making $2, $1, doesn't matter. It depends on how kind of wide you set the strikes versus where the current price is. The tighter you make the Iron Condor or the short strikes is closer to the current price, you're gonna collect more of a credit. But at the same time, that's less room to be wrong. So you have to have that stock trade in a really tight range. Whereas if you widen that out and your short strike on the call side is 350 and the short strike on the put side is like 310, then you have a lot more wiggle room, but you're gonna get paid less. So now you have an understanding of the setup. The risk is defined because you know upfront how much money you can make and how much money you can lose. The order entry, net credit, so you're collecting money upfront, and then the direction of the stock you want to happen is neutral, right? You want it to stay relatively flat within the time span that you set up the trade. What we haven't talked about though is the ideal environment, which is high IV, and IV just stands for implied volatility. So an instrument that shows this panic or uncertainty is a better word for it in the market is something like the VIX, which is a volatility index that measures the S&P 500, but the NASDAQ trades pretty closely with the S&P 500, so you can kind of use this as an overall general sentiment of the market. Back on May 12th, you can see there's a massive spike in volatility, which means uncertainty in the market was much higher. In that situation, options across the board get more expensive because there's expected more volatility within those stocks, meaning they're going to go up and down with the higher volatility. In simple terms, IV being high just means that the stock market is going crazy and it's panicking a little bit, especially when it comes to an index ETF. Usually the implied volatility spikes when everyone's freaking out. And then when everyone realizes it's not the end of the world, IV comes down and all of a sudden options in general become less expensive. When you're selling options or an iron condor and there's panic everywhere, you can make more money from the reversion to the mean when it comes to implied volatility. So everyone's scared, you sell into that fear, and then everyone calms down and you make money. Then if you use a broker like Tastyworks, they have a number in between each of these symbols. This number represents IVR, implied volatility rank, which just shows on a range of the past 52 weeks where implied volatility is relative to the historical range. So a low number means that implied volatility compared to the last 52 weeks is pretty low. If this was 100, that means it's at its 52-week high when it comes to the implied volatility of this underlying stock. So an iron condor is ideal when IV is high, and then you don't really have a directional bias. So you're not bullish or bearish. You're kind of like, I don't really know where the market's gonna go. So I know implied volatility is high. I know it's probably gonna trade within this range. If implied volatility shrinks and trades within that range, all of a sudden my iron condor gets less expensive and I can buy it back at a profit. So you sell it for 150, you buy it back for 75, boom. You pocket 75 bucks. Here's a list of my filled orders, and you can see I put on an iron condor back on May 11th. So I sold the June 18th expiration. I put on a bullish put spread with the short strike of 309 and then a bearish call spread with the short strike of 342. I did this for $127. So when I set up an iron condor, I'm looking for usually a credit of 1/3 of the width of the strikes. And then since I'm unbiased with the direction in this case, I tried to pick strikes that were kind of equidistant versus the current price that the QQQ was trading at when I put on the trade. You can always skew the iron condor as well. So if you have a slight bias in either direction, you can put the direction that you're biased. So if you're bullish, you'd put the put spread a little closer to at the money. So the short strike would be closer to the current trading price, and then you do vice versa if you're bearish. The reason I put on this trade is volatility was spiking on May 11th. You can see that the VIX was elevated. Obviously I waited one more day, it would have been even more elevated, but you never know where the volatility is going to stop. So on that first day and that spike in volatility, I went to an iron condor strategy to take advantage of the increased implied volatility. And at the time, the QQQ had an IVR, I think in the mid 30s or low 40s. As for the price, on May 11th, the NASDAQ was trading, or the QQQ was around 325, 326, kind of that range. And then in terms of profits, I look to take it off around 50%. So I have a working order here to buy back this iron condor for 64 cents or $64. If you're asking, does the width always have to be $3 wide? Does the profit target always have to be 50%? No. That's my personal take and criteria when I put in an iron condor. It's very similar to Tasty Trade, which if you haven't checked out Tasty Trade, definitely go check it out. They're also very good when it comes to explaining options, and I learned a ton from them. The personal criteria for with strike, how close you want to make it to the current price of the stock, it's all up to you. It's depending on your risk tolerance and kind of how you want to set up your iron condor. I know I didn't get into the nitty gritty when it comes to the Greeks. That's kind of another whole video if you want to get into theta, delta, VIX, Vega, all that good stuff. Try to break it down into simple pieces to kind of digest in little bites. Obviously, you can explain an iron condor for probably hours on a YouTube video, but I don't want to put you guys to sleep. If you did enjoy this video, give it a thumbs up and consider subscribing to Main Street Wolf, where we talk about options, stocks, cryptocurrency, personal finance, anything to do with money. Thanks guys for watching, and have a great day.